Hey everyone, welcome to JWood Strategy, and today's going to be a little different. A classmate of mine, Layton and I, are creating an online business. We're trying to make it engaging and also make it make sense. On this online business course, we have a very structured program, but afterwards we kind of have a loosey, comfortable conversation style of certain business terms. And for these videos, we're going to start with the income statement. And trust me, it's not all bad. We're going to provide some examples, some personal stories, and it's going to be a lot of fun. So hopefully you like it. Please subscribe to the red subscribe button below. And here we go.
We're doing the income statement. We're going to look at pretty much the common line items on the income statement, and we're going to go through kind of what they are a little bit more in detail and how people might be able to manipulate them, and just kind of any funny stories and examples we have along the way. So the income statement is tracking how much or what a company really does with the money that its customers give it. So you always start with the money the customers gave it, which is the top line, also known as sales. Total revenue could all be the same thing. But really, money from your customers, clients, whatever you end up doing on a day-to-day basis that creates money in sales is what makes up that very top line. A lot of people have a huge incentive to manipulate sales. A lot of companies track growth on just sales growth, total revenue growth. So if you're a marketing manager or a CEO or anything like that, your goal is probably focused somewhere around growing sales. And if you can grow sales well, you're probably really well known in the industry and you have a great company and you're doing good. If sales are not growing, it's not doing so hot for you. If sales are declining, you're in a real trouble. And so everybody wants to make sure their sales look really good. And so because of that, they manipulate sales one way or another. But also, income statements have a timing issue as well. You see, just like the balance sheet is a spot of just, hey, this is a screenshot pretty much of what's happening on this exact date. An income statement will go from XYZ date to ABC date. So usually it'll be from January 1st to December 31st. That'll be the time series that it tracks in order to collect all the information for the income statement. Of course, you have other ones that are quarterly or monthly and things like that. But since there is always a dead date of that kind of December 31st or whatever it ends up being the last date that matters for the income statement, a lot of companies can manipulate the sales based off that date. For example, there's this very common tool called channel stuffing. And channel stuffing is where you ship out a whole bunch of your products to your customers the day before your date closes. So December 30th, you ship off 50 truckloads of coffee machines. And once you ship off all these coffee machines, you pretty much find out quickly that, oh, once I've shipped it, I can recognize the revenue because I expect to get paid for those, even if the customer didn't really order those. And so this actually happened a lot. This was one of the big accounting manipulations that happened. I think it was actually Green Mountain or something like that. But long story short, they shipped out a whole bunch of coffee machines to different kind of department stores, Macy's and Walmart and stuff like that. And they were like, hey, we don't need these coffee machines. So on December 7th, after that time period was over, they sent those coffee machines back to Green Mountain. I don't even know if it was Green Mountain. It was some coffee company. They made coffee. It might have been Keurig, who knows. But somebody was shipping coffee machines that were not supposed to be shipped. So, but since that return didn't happen until after the deadline of December 31st, the coffee company could report revenue of all those coffee machines that they shipped out, even though they knew there was a really good chance of getting those coffee machines back because their clients never really ordered those. And that's called channel stuffing. If you stuff your product down the channel, and channel is just a fancy word to say to your customers, clients, things like that, then you have the ability to manipulate your revenue by making it look bigger than it really should.
And another thing about channel stuffing to keep in mind is when we mentioned in the balance sheet about accounts payables and receivables is don't do channel stuffing because, again, you're trying to build your relationship with your suppliers and your clients and your customers. When you do that, you're going to hurt the relationship even if you're trying to push that revenue out. Because at the end of the day, they're going to return it and that money's going to be reconciled anyway.
And you also have to think like, okay, so Macy's got 10 times the amount of coffee machines as they wanted. Now it's someone on their staff has to go and deal with this problem that they have way too many coffee machines. Someone might have been like, hey, did you order too many coffee machines? And someone's probably freaking out like, oh crap, did I put like an extra 0 on the coffee machine order? I forgot. So then they have to go check their own records. They say, no, we didn't do this. And they have to send that to the coffee manufacturer. And so like no one at Macy's or any of these people that got channel stuffed is going to be happy with the coffee machine company that's pushing all these coffee machines at them. It's just like if you ordered a Big Mac and they gave you 25 Big Macs. At first you're like, okay, this is nice, but then they're going to make you pay for 25 Big Macs. You're like, wait a second, I didn't want to buy 25 Big Macs. That's exactly how channel stuffing feels for their clients. And so really, as you would imagine, a great rule of business in general is the golden rule. It's just kind of do unto your clients and suppliers like you want them to do unto you. If you can follow that rule, you're probably going to follow all the accounting laws completely fine, and your customers and suppliers will like you a lot more too.
25 Big Macs, it's probably like $35.
It probably is not too much, but it's more money than I want to spend on Big Macs for sure. I got a few 100,000 coffee machines. It's going to be a few $1 million.
Also, another thing to consider when you're thinking about a period in time or the date that each business does their calendar year for the income statement is if you're going to evaluate or compare other companies that are like yours, or you're trying to look at your competitor, make sure that the dates are similar, because some will do December 31st, some will be March 31st.
Walmart is the end of January, which is a super weird time period to use. And so you have to take off that January month or estimate what they did in January in order to compare them to pretty much 90% of everybody else who does it at the end of December. And so whenever you start analyzing companies, paying attention to the small details like dates, how much the units that is on each income statement, because they all do it with thousands, something like that, or some do it with millions, but it's crazy. So you might say, oh, there's 3111 in one column and think that's going to be $3 million. But theirs is already a million, so that could be $3 billion. And those kind of mistakes will cost you a lot if you end up not really paying attention. So paying attention to dates, units, just the timing of everything is really, really important when you start looking at especially the income statement and cash flow statement, which occur over periods of time. The balance sheet is just one screenshot, like we said, of just like here and now, what do we own, what do we not own? And because of that, it has its own issues, but income statement and cash flow, if you want to compare to other places and other companies, you really have to pay attention to what time period is it spanning. Okay, so after we go through revenue, then you have cost of sales. And remember, cost of sales is all the cost that it takes to sell the product or service that you just recorded as revenue. And so for the coffee makers, there's going to be things like glass to make the coffee pot, the wiring to plug the coffee machine in, the plastic to make the housing for the coffee machine, all that kind of stuff. It also goes into the labor cost to put all that stuff together. A little bit of like the overhead costs like electric and rent.
And another thing, he said cost of sales. So remember, there's multiple names and lots of jargon for all these terms. So don't freak out when you think, oh, cost of sales, but what is cost of goods sold? So, or cost of sold. So just make sure it's all the same.
It's all the same. So it always goes revenue, cost of goods sold, cost of sales, whatever it ends up, whatever they list it as, it's always going to be the exact same thing. Pretty much the costs incurred to make the product or service that they sold in that very top line revenue number.
Right.
And I mean, so usually the way it works, the balance sheet is inventory goes to cost of goods sold. That's the transition between those two. And so if you have an inventory, you track the costs it took for you to make that final product. Remember, we started with raw materials, work in progress, finished goods. You track the costs along that way until you get to the finished goods. Then once you sell it, that finished good cost goes into cost of goods sold. But it's kind of a fun category because obviously you have an incentive to make it small because then your gross profits are bigger. But if you're not incentivized by gross profits, then it doesn't really matter. If you're incentivized just by revenue and net profits, it doesn't really matter if you allocate costs to the cost of goods sold or to fixed costs or SG&A or things like that. So some people try to manipulate it to make it look better than they really should. Other people won't. It kind of depends. It's really good to track accurately internally because then you know exactly how much product or profit, you know exactly how much profit you're making per each product that you sell, which is always handy to know when you make good managerial decisions and things like that. If you have a more service-based company or business model, then you have a lower cost of goods sold. If you have a more product-based or good-based kind of business model, like selling Coca-Cola or selling Big Macs, that's going to have a higher cost of goods sold. And so it's kind of like on the far end of it, you could compare like Facebook. Like, what is the cost of Facebook to get an advertisement from, because so Facebook makes all of its revenue pretty much through advertisements. And so if you were to advertise on Facebook, you would go in there and you'd pay them X amount of dollars and your advertisement would be shown to people on their websites. The cost of them showing that to someone on their website is probably like pennies. I have no idea how they actually value that, but I'm sure it's super, super low, like a very low cost of goods sold. Some software engineers, their salaries get plugged into that stuff, but it's going to be very, very low on a per sales dollar basis. The opposite would be like GM or Ford, who makes cars. So cars, they have a lot of costs that go into making the car itself. All the steel, all the aluminum, all the engineering that goes behind the engines, the drive train, everything like that. Then on top of that, you have the sales commissions, and you have a whole bunch of other stuff that gets the finished product. And so once you have the finished product all finished off and ready to go, the paint and everything, it's ready to be driven off the lot. That is going to have a lot higher cost relative to the sales price than Facebook's advertisement will. And so as you'll see, the more on the service side of the business that you are, like Facebook, the lower your cost of goods sold are going to look compared to your revenue. And then on the other side, if you're high on the good side, it's going to have a higher cost of goods sold than compared to revenue as well. And the easy way to look at that is just what's next in the kind of income statement, which is gross profit. And remember, gross profit is just sales minus cost of goods sold, and you have gross profit. And remember, we always want to look at profit in terms of margin because it allows you to compare two different companies or two different industries. And remember, margin is just the profit divided by the sales number. That's how it works every time.
And margin's always a percentage too.
It's a percentage.
And this, remember, is for one of three profits. This is not all the money you make. So everyone always gets confused of revenue and sales as look how much money I make. They don't realize the costs and the taxes and all the mumbo jumbo that goes into it. So gross profit is just the profit that you made from creating that product. So if I had a new beverage I want to sell, then I have to figure out what all the costs of that product is. And then when I sold it at, let's say it cost $1.50 to make a soda, and I sold it for $3 and I sold it to one person, I made $1.50 or 50% margin and gross profit.
Speaking of gross profit, let's make this easy. So I just Googled Facebook gross profit margin. So their most recent gross profit margin was 83%.
Wow.
That's super high.
Wow.
Yeah. And
rarely it's around the 40s if you're good.
Yeah.
If you're lucky.
And so you can see that obviously they are super heavy on the one second, I pressed the wrong button. They're super light on cost of goods sold. Like for every $1 they make, it only costs them 17 cents in cost of goods sold to make that dollar. Compared to Ford, so Ford, same time period, their gross profit is 12%.
Wow.
So almost complete flip. So that kind of shows you the exact idea between, okay, Facebook is a service-based organization. There's not a lot of costs that go into providing the service they provide. So their gross profit margin is going to be huge, that 83%. Ford has a lot of costs that go into selling one car. They have to make the car itself, which is a very intense, big piece of equipment. And so because of that, their gross profit is super small, like 13%. And so that's the kind of crazy thing when you look at these kind of companies and things. That's also why it's handy to look at the percent margin instead of just gross numbers. Is who knows what the number is for Facebook? It could be like 5 million. It could be like 10 million. Who knows? It's probably in the billions in all honesty. Same with Ford. It's all probably in the billions. But comparing billions to billions isn't quite the same as comparing percentages to percentages. Just very interesting kind of way to think about all this stuff is gross profit is a good way if you have no idea what kind of company you're looking at. You can look at the gross profit. If it is high, and high being, let's say, more than 50%, you could say, okay, well, this one's probably a service-based company. If it's less than 50%, you can say, okay, this one's probably a product or good-based company. And that's probably the way to look at most of this stuff is like, okay, gross profit allows me to identify maybe how this company operates in certain ways because you understand what goes into it, It's the cost to make the product that they do sell.
This is the first time where you can actually kind of analyze the company and make good judgments out of it, or even recognize, oh, of course their margins, gross profit margins are high because this is this type of company. They're a retail company, or they're a internet-based company. So once we dig deeper, we'll get more into how to analyze and maybe even value a company.
Exactly.